Hello everyone. Today we will be learning about bad debts and provision for bad debt. So let us first understand what is a bad debts. Okay. So bad debts. Bad debts refers to the account receivable or debtors that will not be collected. Okay. So when some debtors cannot be collected, it is known as bad debts. Okay, so in short, when they are unable to give the money, okay, whatever is a receivable from debtors or whatever we call it account receivable also, so whatever amount is receivable from them, when the particular debtor or account receivable are unable to give the money, it is known as bad debts. So as you can see, by the nature of bad debts, it is an expense, right? Whatever was receivable is no more receivable, so it is an expense. So the bad debts are subsequently written off and transferred to profit and loss account. Okay, now there are two methods. Okay, one is bad debts, which can be written off and transferred to profit and loss account directly, or we can also make a provision for bad debts, or it is also known as reserves for bad debts. So first we will be learning about the first method, that is bad debts are written off and transferred to profit and loss account directly. Then after that we will be learning about what is provision for bad debts. Okay. So now what will be the entries for the bad debts? Let's see what will be the entries to the bad debt. Okay, so bad debts entry will be bad debts account debit, since this is an expense. Okay, so we are debiting to accounts receivable or debtors account. Okay, that is whatever is that particular debtor or account receivable, we are crediting that account. Okay, so this is what will be the entry for the bad debts, and at the year end this amount of bad debts will be transferred to the profit and loss account. So for transfer, the entry will be profit and loss account debit to bad debts account. Okay, so now let us see one example. Okay, what is bad debts, and then let us pass the journal entries and prepare bad debts account and debtors account. Okay, this is an example. Following is the list of debtors account receivable as on 31st March 2006. So that is a year end, and then the name of debtor and the amount is given in rupees. From the above list, A and C will not be able to pay rupees 10,000 and rupees 2,500 respectively. So A, what is A? Here it is A. So out of 25,000, A won't be able to pay 10,000 rupees. Okay, and C, where is C? C won't be able to pay the entire amount of 2,500, right? Mr. A paid the balance amount on 31st March. So balance, what is the balance? 15,000. 25,000 is paid. Okay, so pass the journal entries for bad debts and prepare ledger account, bad debts account, A's account and C account. Okay, now let's see what are the journal entries. Okay, so first 31st March 2016. Okay, so first is what? A, we will pass a journal entry. First transaction is what? A won't be able to pay rupees 10,000. So what will be our journal entry? Bad debts account debit 10,000. To A's account 10,000. Okay. Then narration you can write being bad debts written off. Okay. Then next 31st March 2016 again. C won't be able to pay 2,500. So entry will be bad debts account debit 2,500 to C's account 2,500. The narration is being bad debts written off. Okay. Now what is the next entry? Next entry is Mr. A paid the balance amount of how much? 15,000. So we'll pass one more entry for the payment. That is also on 31st March 2016. Okay. So he has paid the balance amount. So what is the entry? Bank or cash account debit. What is the amount? 15,000. 2 A's account. What is the amount? 15,000. Okay. Being balance amount paid. Okay. Now I have already prepared all the ledger accounts, format of all the ledger account. We will post all these entries. Okay. So first of all, A's account and C's account, okay, they are debtors account. Okay, so there are some balances. We will first post the entry for the balances. To balance brought down. Since they are debtors account, it will have a debit balance, right? So let's assume all these balances are at the beginning of the year. That is 1/4/2015. To balance brought down. How much is this? For A it was 25,000. Okay, and for C it is 2,500. Okay, now let's post all these entries. First entry, bad debts account debit to A account. So on 31st March 2016, on debit side of bad debt, to A's account. How much is the amount? 10,000. The second effect will be A's account credit side, by bad debts account. How much is the amount? 10,000. Now the next entry, that is bad debts to C's account 2,500, 2,500. So C's bad debts account first will give the effect. Bad debts account debit side, to C's account 2,500, and then C's account credit side by that's account 2,500. Then there is one more entry, payment entry. So A has paid the balance amount of 15,000. So bank and cash account debit to A's account 15,000. So on A's account credit side, first effect will go to bank, cash and bank account debit side. Okay, but since we have not prepared that ledger account, we won't be giving that effect. Okay, 31/3/2016 by cash or bank account 15,000. Okay, so now let's close all the ledger account. Balance is 25,000. Here also balance is total is 25,000, so no balance. Okay, then here seize account, total 2,500, total is 2,500, so no balance carried forward. Then what about the bad debts account? Now bad debts account is showing a debit side total of 12,500, right? Now this bad debts will be transferred to profit and loss account. Since in this example there is no provision for bad debt, this will be transferred to profit and loss account debit side 12,500. Okay, so this is the way we pass a journal entries for bad debts. Now we will see provision for bad debts in next session.